Good evening, ladies and gentlemen. Today we would like to talk about Brexit and what the EU and what the United Kingdom had lost during this tragic event or series of tragic and unfortunate events. At least what we can see in November of 2020, because we can see that it's not just tragical, it's also a never-ending saga, or at least looks to be. So if you're looking on macro variables to identify the potential loss from macroeconomic point of view, that what is happening with the EU statistics when we are taking out this United Kingdom from the equation, then we can see that mostly we will lose uh, 15 to 14% of population, GDP, and relevant manpower from employment. Because if you are looking on the people in the relevant 20 to 64 year old part of the society, then we can see that also we are losing human resources as well. And of course, we are losing some public debt to GDP, but actually, it's highly irrelevant because they are not part of the Eurozone, so they are on their own. If they would need help, then IMF supposed to be the supporter in this case. But we know that the European Union traditionally is an agent uh, for foreign trade, and it supports the trade integration of the member states. That was the job since the 60s, at least since it was funded and the predecessors were funded. And still we can see that, yeah, so the UK, or the importance of the European Union from UK's trade perspective is lower than the average. So in average, an average member state exports, uh, sorry, so for average member state, uh, the EU market is relevant as 63 to 4 percentage. So if they are importing, 63 percentage of this import is coming from the European Union, or if they are exporting, then 64% is going to European Union. So if we are looking from this perspective, then we can say that, yeah, the UK is less integrated because just half of their import is coming from the EU, and just 46% of their export is going to the European Union. Come on, we're still talking about half of the foreign trade, which can be biased by tariffs, duties, and so on. And also, if you are looking on the issue of what was the market share of this hypothetical EU market, we can see that actually the from export point of view, the UK had a 8.8% of market share. And if you are talking about the import, then from import point of view, it was 5.4% of market share. So this will be missing from the general European Union market. It's a huge empty territory now which was cut out. And also we have to see that, okay, but what was the importance uh, as an exporter or importer for global perspective? So if the UK was exporting not to the EU but on the global market, what was their share from the entire European export? And they were contributing to the 11% of the European Union's total external export, and also they were conducting 15% of the EU's global import. But we know that some part of this import was re-exported elsewhere inside the European Union because maybe just the main harbors were located there, but these goods and or services will be sold finally elsewhere. Just yeah. So the import statistics can be biased this way. So when we are talking about this foreign trade bias, then we have to say that yeah, so it will be a huge economic burden. So if you are looking on a recent journal paper, then we can say that this is highly fixed. So if we are looking on the different WTO tariffs for the most favored nations, which can happen or which will be applied if there is a no deal Brexit happening, then we can see that many components, many products will suffer from 2 to 10% of import tariff. And also it generates export losses in this case, even to non-relevant non-EU members like Turkey or China or the US. So it will generate a fall in non-financial corporations margins, and actually now we can see it. If we are focusing on foreign exchange rate, so what happened with the British pounds against the euro, then we can see this timeline here. So when the crazy idea appeared in the UK politics that they should do this referendum, and then when the result was emerging, so we can see that yeah, the British pounds was weakening as a result. So there is this excellent paper which processed which variables were contributing to this appreciation or depreciation of the British pound. So in this case, we are focusing on the depreciation. So if we have positive numbers here, it means that the British pound is weakening against the euro. And also they backtested it, so they checked the same model against the US dollar. Actually, results were highly the same, so the result was robust. And actually, what we can see here that Brexit news were relevant. So until these shocks which are determined here are used or represented only as dummy variables, so if there was some sort of an announcement, it regardless it's positive or negative, it had no significant impact on the depreciation of the exchange rate. But if they were separating them, so they were defining a dummy variable with bad news and dummy variable with good news, then they became suddenly significant. And actually, bad news had way bigger impact than good news. But this is highly a general thing because usually stock markets and other capital market or financial market indicators are always reacting asymmetrically, so bad news are always hitting them more. Just in this special case, it's really hard to generate relevant good news if the entire situation is completely bad. But we can see that, okay, bad news are contributing to decreasing or depreciating exchange rates. It's highly obvious. Also, what is relevant here that they were checking the funding costs. And actually, we can say that it's nothing new here because if you have if you are providing interest premia against a foreign entity, then it should drive in the capital, so it should contribute to the appreciation of the currency. And in this case, we can say that yeah, this is what happened. So mostly they were able to measure the interest premium. So it doesn't matter that it's central bank interest rate, it's bond market interest rate. So this thing was working. Uh, if the central bank or if the UK bond market started to increase their interest rates or the yields, then the British pound started to appreciate. So yeah, it's working. If the euro area or the European Central Bank increased their interest rate, or the yields in the euro area started to increase, then the British pound started to depreciate. So nothing new here. What is interesting that actually if the stock market in England started to increase, then actually British pound started to appreciate, which is a strange thing for me because yeah, it's still copying. Uh, uh, yeah, so it's I would think that if stock market increases, then actually currency should appreciate instead of depreciating. But yeah, it's opposite. So and also they were running this model not just on the changes of the exchange rate, but also on the volatility of the exchange rate, and results were the same. So it generated uncertainty on the market. Because in many cases, companies were afraid of the globalization of the UK economy, which is highly relevant for a maritime economy, obviously. And and productivity decreases can be happening. So actually, still we can see that okay, GDP is growing, just if not supported by growth in productivity, then sooner or later you will find increasing external imbalances. And also there can be a problem that Brexit can trigger aggressive expansionary monetary policy, which can also contribute to the depreciation of the British pounds. So this is one thing. And we know that, okay, exchange rate is relevant from exporting or foreign trade point of view because it makes imported goods more expensive. But we know on the other hand that yeah, but if partially your foreign trade is internalized by multinational companies, then this exchange rate exposure is not that relevant. But let's see funding costs, because funding costs can be relevant for our companies. So actually the model is highly similar because we can see that these two journal articles were published by in the same journal at the same time, just and also one of the authors are the same. So these articles they did a really good job because the papers are excellent. I can recommend you to read it if you want. So credit spread means in this case that what is the premium for private companies above government bond yield. So if you can fund the government or public debt at a yield level, then what should be paid as a premium by private companies. And in this case, they were really precise because they checked financial, non-financial companies. They checked 7 different business sectors like manufacturing, like chemical industry, and so on. So you can find it in the paper that which 7 is this, but they were really comprehensive. And also they checked short-term, medium run, and long run maturities. So what is happening? Mostly the same thing happened in all the cases. And obviously they compared UK and the euro area. So if this credit spread increases, then it means that funding costs are increasing for the corporate sector. And obviously they used, because uh, you can find similar authors in both journals, actually they used the same dummy variables to represent Brexit events. And obviously Brexit shocks always increased funding costs. So that's why if you are a politician, then you have to be really careful what you are doing because it will have costs for your companies. And yeah, so you can see that it had an impact. And also, central banks are trying to fight against it. So they are trying to absorb these shocks. So we can see that if central bank was cutting down the interest rate, then these spreads can be decreased. Okay, that's why we have central banks, partially. Uh, Also, we can see that this forward swap rate, actually it means that if this forward swap rate increases, then actually people are thinking that sooner or later there will be some recovery. So for me, I don't like this indicator because it's a bit foggy, but authors were saying that it should be negative, and it was negative. Just I like the inclusion of this. Uh, Liquidity risk. Actually, it's surprising because this should supposed to be positive. If liquidity risk increases, then spreads should be increasing, but it was surprisingly negative. Maybe contribution of the central bank was uh, measured here as well. So on commercial monetary policy, when central banks are purchasing different bonds, not just public issued, so government bonds, but also corporate bonds as well. So maybe it was a side effect because nowadays central banks are market makers of last resort. So it's reasonable to think that this is happening. And also we can find here term spread. When we can see that the premium between long run and short run government bonds, so actually the shape of the yield curve is represented here, but actually in this case the coefficient was sometimes negative, it was sometimes positive, sometimes it was not significant, so it's highly inconclusive what happened here. So it's supposed to be negative, but yeah. CDS. So if credit default swap increases for government bonds, then actually it means that it's riskier to fund the state. So it means that it will be riskier also to fund private companies at the same time. So this is supposed to be positive, but it was positive only in several cases. So mostly it was not significant. Also, we can see that stock markets. Obviously, if stock market increases, stock market index increases, then funding costs will decrease, so it was highly obvious. Also, then there were two global indicators. One was global volatility. So people are checking options written on S&P 500 indexes because it represents global economy, and if implied volatility increases, it means that there is an increasing uncertainty on the markets. So obviously if this indicator increases, then the credit spread will increase, and also we can see risk aversion. So if in the US the mediocre corporate bonds have an increasing premium against the US government bonds, then it will contribute also to the credit spread. And it was highly clear that it's has this contribution. So maybe central bank can play with liquidity risk, maybe they can play with term spread, maybe they can play with this forward swap market, but and also with the central bank rate obviously. But yeah, mostly the market funding conditions were going from not that great to terrible at this time period. So it became more expensive to fund British companies due to Brexit. And now let's see that what we are talking about, because actually the problem was uh, that actually the British or the Brexit was motivated by the potential gain, what they can save on EU fundings. But if we are looking on the data, so I can recommend you to check this URL. Mostly it's irrelevant. So the entire European budget is 1% of the GDP, of the EU GDP. So this money is like the British football. It's marginal. If we are looking on the GNI, then this yellow line represents uh, the share of the EU funding from the UK's GNI. So we are talking about something which is between 0.2% and 0.5%. So it's less than 0.5% of the GNI annually. So we can say that, yeah, they save this money. Nice. And they are endangering half of their foreign trade. That was great, gentlemen.